Hello again, you're with Smart Money this Monday evening here on Bloomberg UTV. Now let's talk about fixed deposits. The face of fixed deposits, at least how they function, is fast changing. If you're one of those who thought that parking money in fixed deposits will take care of your retirement years, now you're in for a shock because the country's largest PSU bank, State Bank of India, has announced a new floating interest rate regime. This means that going ahead from here, returns on fixed deposits will be linked to the base rate. What is the base rate? The base rate serves as the minimum floor rate below which banks cannot fix interest rates. Base rates were introduced by RBI, you remember, from July 1st this year. And experts are saying that fixed rate returns on fixed deposits may become history over the next few years as banks are likely to focus more on market-linked deposit rates. So in a scenario where the definition of the good old fixed deposits, FDs, is set to change now, how should you go about building that retirement corpus? Let's talk to Sumeet Vaid and find out. He's a certified financial planner, a friend of ours here on Smart Money. Sumeet, good to have you with us. Now, this face of fixed deposits, like we were just saying, is changing, and looking at floating rates of interest on fixed deposits, is that a good thing or not? For us who look at fixed deposits, always looked at fixed deposits as a safe, a conservative kind of investment. When you can't think of anywhere else to park your money, you go the fixed deposit route. How should that change?
Hi Vikram, thanks again for getting me on your show. It's always a pleasure. We are living in very exciting times. At one end, if you see regulators, both SEBI, IRDA, RBI are trying to work towards benefiting the clients or customers as much as possible. So mutual fund entry loads are going, RDA is coming up with ULIP guidelines which are very client and customer friendly. Banks are talking about base rate based lending mechanism itself. So that's the good part which is happening. On the other end, you also are seeing the life is becoming more complicated and complex for the end investor or a customer, because now things are moving from fixed to variable part. That means if you're planning your life, if you're planning your finances, if you're planning your retirement, it's very difficult for you to go and predict what's going to happen over a period of time. In fact, this is an ideal time, and I want to make a very strong point in your program that most of the families should have a qualified financial planner as their family financial planner, because these are the times when you really need help, because things are not going to be stagnant and simple as they used to be.
That's right.
So keeping that in mind, my comment on this thing is, that's the right way forward. Because if at one end you're going to benefit from the benefits of base rate, over a period of time towards your loans which you're taking from banks, so same way bank will have to say that I'll have to make sure the fixed deposit rate which I give has to be linked to the base rate part. So from a direction point of view, it's a right direction.
Correct.
But what does it mean for a normal lay investor who's trying to plan for his long-term investment needs is a very interesting proposition here.
Correct.
What it means is that you need to keep realigning your portfolio on a regular basis.
Exactly. Now, how do you exactly do that? That was my next question to you actually, Sumeet. Retirement planning, that's a very important part of any financial plan. And we talk about a lot of that in our weekend editions of Smart Money. Fixed deposits, like I was saying, a lot of us look at it as a safe bet to protect our retirement corpus from any uncertainty out there. You have money put inside mutual funds, etc., but you offset it by putting in money in fixed deposits. But now, with a new floating interest rate regime for fixed deposits, that outlook would change a little bit, especially when it comes to retirement planning. Would you agree?
Definitely, Vikram. As we know, fundamentally, retirement planning consists of two stages. One is the accumulation stage, in which you plan for how much money do you need to save on a regular basis for what period of time, so that post-retirement you are able to lead the same quality of life, the one which you're living right now. And the second phase in retirement planning is distribution phase, where you plan the monies which you have accumulated to be invested in a certain way, so that as much time you live post your retirement income is not there, post your retirement, your income is not there, you should be able to suffice your day-to-day monthly expenses. Now, in case of accumulation phase, you can do it with help of long-term instruments like equity-oriented mutual fund or direct equities or debt-oriented mutual fund. But when it comes to distribution phase, that's where it's very important for you to go into safer instruments where a returns are kind of directionally fixed. And that's where traditionally fixed deposits used to fit in. With the changing environment, I think there is a call which needs to get taken up. What kind of fixed deposits, what bank, what kind of volatility which will need to be planned has to be really articulated. But if you really go deeper into this, on front of it, IRDA is also talking about Now pension schemes being coming by insurance companies which will have minimum guarantees of 4.5% or near about that. So there are a lot of things which are moving in. At one end, if fixed deposit is not going to be a very fixed kind of an instrument for retirement, you might have some of the new emerging opportunities in some of the other instruments coming through some of the other structures.
Right. So
yes,
many products.
There is a challenge, but so are opportunities.
That's right. The problem is that there are so many products out there in the market, in the personal finance space. Sometimes it becomes very difficult to choose. And the products that are out there have been over there for a long period of time, like fixed deposits. They are changing quite drastically. So let's take a realistic scenario. If I have 30 years left for retirement, what should one's asset allocation look like, considering the changes that are coming about in the fixed deposit way, at least how we looked at it traditionally, now looking at floating rates of interest on fixed deposits?
If you've got 30 years for retirement, then ideally speaking, in a normal circumstances, you should be going in for an aggressive portfolio strategy. An aggressive portfolio strategy differs from each financial planning firm to each financial planning firm. In case of Freedom Financial Planners, we have aggressive allocation, pegged at around about 75% in equities and 25% in fixed income. Now, 75% equity get further divided into, large cap, mid cap, and so much in various mutual funds of reputed asset management companies. When it comes to fixed income, we till now have been advising a combination of fixed deposit along with some short-term funds, etc. Provided you can really go and get a good attractive rate for long-term fixed deposit itself. In a new environment, we'll wait and watch, because we need to really figure out how fixed deposit rates are really going to go and turn around to do that. So our advice will be 75% equity, 25% fixed income, and wait and watch for some more time for fixed deposit rates to really give you a direction. But till that time, you can look at shorter end of mutual funds, because that's where the volatility is less. So that will be an ideal portfolio for somebody who's got minimum 30 years to go for retirement.
That's right. Short-term funds is something that we have been talking about, certain debt funds as well. We've been speaking to debt managers of several of these funds too. But recently, Sumeet, like you were talking about, IRDA had come out with a regulation of assured returns, 4.5% assured returns on pension plans. So then, looking at pension plans as products, should investors look at them at any point in the two stages of retirement planning, the ones that we are talking about over here, something that you were mentioning, accumulation and distribution phases?
Definitely, pension plans under the new IRDA guidelines makes a lot of sense, and especially that's the view which Freedom Financial Planner has, which might not be agreed by a lot of insurance companies or by a lot of other financial planners. Having said that, in the distribution phase, when you plan to meet up your expenses during your life, when your income is not there post-retirement, I think that's where a guaranteed pension plan really fits in. It gives you a kind of directional annuity. What I mean by direction is that particular annuity income which is being planned for in your retirement phase will be not less than 4.5%. Now that's a great benchmark. It does limit your upside, but anyway, post-retirement, when I'm planning for annuity, I'm not looking for big upside. I'm looking for consistency of income to make sure my expenses are met, and that's where this product fits in.
Fair enough. So that's as far as, retirement planning is concerned. But the other thing is new pension scheme, NPS. Now that has always been a good option. Of course, we haven't seen that kind of traction build into a new pension scheme. But looking at the changing face of fixed deposits and the way interest rates are going to move, floating, do you think new pension scheme is an option that you will also suggest besides these pension plans that we're talking about?
See, new pension schemes is a great scheme, but you cannot kind of use it as an alternative to fixed deposits or any other fixed income allocation, because new pension schemes, according to us, really fits on the equity side, because it's providing one of the lowest expense oriented equity indexing strategy, and over a longer period of time that really matters and it really suits. So it makes a lot of sense. We should look at it, but not because fixed deposit rates are not very good or they're becoming very volatile or variable. Those are two separate coins, and they need to be treated separately itself. Look at NPS, look at equity oriented NPS over a longer period of time, because the expense ratios in that is very, very low. Though we are still to await the track record, it's too early to new NPS scheme to really figure out how it's performing. Given its expense structure, the sense is the performance will be good.
All right, Sumeet, thank you so much for joining us with those ideas. If you're looking at retirement planning, that's something that we're always concentrating over here on Smart Money. You can always pipe across whatever doubts, whatever questions that you have on your mind at our email ID, which is smartmoney@utvmoney.com.